Well, good afternoon. It's 4:25 here in Cincinnati. We're into the second last week. We're here tonight and this afternoon to discuss chapters 19 and 20. Chapter 19, using securities markets for financing and investment opportunities. And in chapter 20, we'll talk about money, financial institutions, and the Federal Reserve. So let's look at the learning objectives for Chapter 19. Describe the role of securities markets and of investment bankers. Identify the stock exchanges where securities are traded. Compare the advantages and disadvantages of e-financing by issuing stock and detail the difference between common and preferred stock. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds and identify the classes and features of bonds. We've done a little of that previously. We'll do a little more here this evening. Explain how to invest in securities markets and to secure investment objectives such as long-term growth, income, cash, and protection from inflation. Analyze the opportunities stocks offer as investment and analyze the opportunities that bonds offer as investments, and then explain the investment opportunities in mutual funds and exchange traded funds, and then finally describe how indicators like the Dow Jones Industrial Average affects the market. So let's get into this, and we'll talk about what is really a very interesting thought is investing. And what I want to say to you at the very beginning is that if you invest your money in the stock market, you're taking a risk. I don't mean that to sound bad, but that's a fact. You are taking a risk. The money that you invest is not insured, and none of those investments are insured, so you're taking a risk. The younger you are, the more risk that you're willing to accept. As you get older, you're willing to accept less risk. So one of the things that you have to understand, and I want you to understand, and hopefully we can get this across tonight, and I don't mean to sound like I'm preaching to you because I don't mean to do that, is to understand that the risk involved in any type of investment, that if you are concerned about returns and having your investments insured, you should stay with things like savings accounts, which obviously don't pay a lot of interest these days, and certificates of deposit and things of that nature. If you can accept risk, then you should look at investing in the stock market. I would suggest to you, and the book points this out, that if you're interested in investing in the stock market, you should start out with either mutual funds or exchange traded funds. We'll get to both of those a little bit later tonight. But there is a little bit more protection in investing in those types of securities than there is in the regular stock market by simply buying stock. Now, having said that, you can buy stock in well-established companies like Procter & Gamble, and Coca-Cola, and General Electric, and General Motors, and companies of that nature that tend to pay a dividend on the stock either quarterly or at the end of the year. A couple of things you can do there if you're into doing this is you can take those dividends and roll them over to buy more stock. My wife and I own Coca-Cola stock, and that's what we do with our Coca-Cola stock. We get dividends, and then we reinvest the dividends in buying additional stock. I'm not saying that that's something that everybody should do. You have to decide what your long-term objectives are. If that's not your long-term objective, then certainly you can take the dividends out. I have a cousin who has a significant amount of Coca-Cola stock, and she takes her dividends in cash, and that's fine because she's at the stage of her life where it's more important for her to have the cash at hand than it is to buy more stock. So let's look at securities markets. Securities markets are like any other market that you know of, like going to the supermarket or going to a farmer's market or something of that nature. The difference is most of us don't visit those places on an everyday basis. And the only way most of us can buy stock in the stock market, or mutual funds, or electronic traded funds, is go through a licensed broker. We are not licensed brokers for the most part. Most of us are not. We're buyers, and we go through a licensed broker or a brokerage house. And what the securities markets do is they bring buyers and traders, buyers and sellers together to make an exchange. So notice that here that these financial marketplaces have two primary functions: assist businesses in obtaining capital for the long term, and then provide people like us, private investors, a place where we can buy and sell securities for our own well-being. Now notice securities we're talking about for the most part, are stocks and bonds. Now, there are two markets here for the securities: the primary market and the secondary market. Primary market is set up for new securities. The secondary market handles trades of securities between investors like us, or businesses, they're investors as well, and the proceeds of these transactions go to the seller. That's just like when you go to the farmer's market and you say to the farmer, I would like to buy 2 pounds of your tomatoes, however much that is. Of course, large tomatoes, it may only be two tomatoes for 2 pounds, but that's beside the fact. And the farmer says, okay, that's $2. So you get the tomatoes, he or she gets the $2. But in this case, if there's any proceeds over and above that, they go to the seller. So the difference is you wind up with the stock in your hand, and the seller has the money he or she wants from selling the stock. Then we also have a thing called an initial public offering. That is simply when a organization, a business that is there to make a profit, decides to sell its stock or to offer its stock, that's a better way of saying it, to the public for the first time. And usually they have an investment banker handle that initial public offering for them. And you may have read in the paper in the last year or so about the initial public offerings for Alibaba, which is a Chinese cloud-based computing company, and among a number of other things. Google has had initial public offerings. Apple has. Facebook has recently had an initial public offering within the last 18 months or so, maybe a little bit longer ago than that. So what this is simply doing is taking the stock public. Now there's also a reverse, and Michael Dell did that when he and his investors pulled Dell Computing off the public market and bought that stock back. So Dell is now a privately held company. It is no longer a publicly traded company. Now this talks about the investment bankers, this particular slide. And notice what they are in the business for. They are in the business to help corporations in the issuing of and selling of new securities, initial public offerings, or maybe a company wants to offer more stock for sale, and it goes through an investment banker. And then we have institutional investors, and these are large companies, but normally speaking, they are either pension funds like CalPERS, which is the California Personal Retirement System. New York has one. I mean, most states have them. I just happen to know the acronym for the California CalPERS. California also has another retirement system by a different name, which I don't know very well. And so what these folks do is they invest their funds in things like mutual funds and other type things to try to earn money to make sure that the pension funds are solvent. Many pension funds in the United States are not solvent, or not as solvent as they should be. And one of the reasons is because they pay into whoever is controlling the pension fund for them the minimum required. Well, that was okay for a long period of time when the stock market was doing relatively well prior to the big meltdown that started late 2007, manifested itself in 2008, and a couple of 18 months or so beyond that. And so you want to have a income coming in to keep that pension high, so it can give the funds to the people that it has promised that they would give funds to, retirement funds. So those are what's known as institutional investors. And by the way, institutional investors, especially an organization like CalPERS, are so large that their buying and selling of mutual funds or individual stocks, or in some other cases they're in hedge funds, can really move the needle. What I mean is the price of the share of stock exponentially, either up or down. We have several different markets. The stock exchange is really a market. That's all it is. And it says a little bit differently. But again, remember, this is a place where buyers and sellers come together, normally through an intermediary known as a stockbroker, or as the securities broker is a better term. A couple of are mentioned here. One is the over-the-counter market, OTC. And these were often called penny stocks. Now, what do I mean by that? They're stocks that didn't have a lot of value. Now, that does not mean to say the stocks were not valuable. What it means to say is that were not worth money. Like if you go to Wall Street Journal today and look at the stock quote for General Electric, for instance, you'll see it's around $30 a share. I think it's a little bit less than that, but I'm just using that as a medium. You won't find stocks on the over-the-counter stock market that high. They'll be in the $5 range and lower. You may see some higher than that. And also notice that they're not listed on the national exchanges like the NASDAQ. Now, why is the NASDAQ different from the New York Stock Exchange? The NASDAQ does not have people on a floor like the Wall Street, like the New York Stock Exchange does. If you watch CNBC or some of those other cable channels that watch the market, you'll see people standing there at terminals, entering trades and making sales and things of that nature. NASDAQ is completely electronic. It does not have anybody on a floor making trades. So that's the NASDAQ. And here are the top stock exchanges throughout the world. NYSE, New York Stock Exchange, Euronet. That is the official name for the New York Stock Exchange. Most people will simply say NYSE. Then we have NASDAQ, London Stock Exchange, also known as the FTSE Financial Times 100, Tokyo Stock Exchange. I don't remember. I want to say Hang Seng, but that's not right. That's Hong Kong. And you have the Deutsche Börse. There's also the French Stock Exchange, which is the CAC 40. I believe that. I believe I'm correct in that, saying the CAC 40. And please don't ask me what CAC stands for, because I can't tell you. Now here we have one of the most important, influential federal agencies is the Securities and Stock Commission, or excuse me, Securities and Exchange Commission. I'll get it here in a minute. SEC. It was created in 1934. The first chairman of the SEC was Joseph Kennedy, father of President Kennedy. And he was chosen by Franklin Roosevelt simply because Kennedy was very active on the stock market, and Roosevelt wanted somebody to be in charge of that who knew the ins and outs of the market. That's why Joseph Kennedy was chosen to be the first chair of the SEC. SEC has regulatory powers over various and sundry companies. They can levy fines. They can stop a company from trading. They can do a number of other things. One of the issues, however, that the SEC has is it's probably not funded as well as it ought to be, and it probably doesn't do all the investigative work that it should do simply because it tends to be understaffed. This next thing, the prospectus, this is what the SEC requires every company that is trading securities on a public market to provide a potential investor. And this is, pardon me, financial information that is given to an investor. And this tells the investor, this is what the stock has done over a period of years. And this is what we project that the stock will be able to, or this particular security, I mean, it's not just stock, what this particular security will be able to do, it will gain in value. So at least this is our estimation. That does not mean that that's going to happen. And almost, I think every prospectus that I have ever read will say past performance is no indicator of future potential. And so this just gives you what the security is, what its performance has been, and particularly on the stock. And by the way, this goes for mutual funds as well. Give you some kind of an idea of what you might be able to expect based on what it has done in the past. And again, of course, as I say, past performance is no guarantee of future potential. Stocks just say if you own stock, it says you own a portion of the company that issued you and sold you the stock, even if you go through a broker. And what we have next is a stock certificate. If you have a certificate, I'm just going to hold something up here, as you can see. It's a piece of paper, and it will have some writing on it and say this stock, the bearer owns 100 shares of stock. Now, what you will find is that very few companies issue stock certificates today. They will issue you something via electronic means, by email, and say you own so many shares of stock, but you will not get a certificate. Now, I think you can request a certificate, and if you do, the company is obliged to give you that. But for the most part, all stock certificates are held by some bank that controls this for the company. Pardon me. And you'll have something electronic says you own X number of shares of stock. Now, the cousin I was talking about does have stock certificates, at least from Coca-Cola, and it says she owns X number. Each certificate has a number on how many shares of stock she owns. A dividend is something that a company pays from the profits it generated. I want to make it clear, and each of you know this, and you wrote it in most of your posts regarding stocks and bonds, etc., that no company is required to pay a dividend. And dividends can either be paid as cash or as additional stock, depending upon the option that the stockholder chooses. We kind of talked about that before. But again, no requirement to pay a dividend, ever. Well, this okay. That's the language. What are the advantages of a company issuing stock? There we are at the first one. Never have to be repaid their investment. No obligation to pay dividend, and obviously issuing stock, as most of you mentioned, can improve an organization's balance sheet because it has money coming in and has not taken on debt. There are disadvantages, and each of us, we've talked about these. The common stockholders have a right to vote and to elect the board of directors. And if the stockholders become disgruntled, they can cause a lot of problems for both the board of directors and for the management of the company. Now, when I say they can cause a lot of problems, I do not mean to say that what the stockholders are doing is wrong. In many cases, stockholders' wishes are not always adhered to. And that is probably not the right way to go. We find many today that many stockholders are becoming very contrary and not going along with the wishes of the company. Obviously, issuing new stock can affect the control of the company, especially if somebody gets a large portion of stock. He or she, that person can be can cause a lot of concern. There was a fellow here there is a fellow by the name of William Ackman. I don't think it's Ackerman. I think it's Ackman, who owns a investment company called Pershing Square. And he through his company, he bought a large percentage. Now, large is I don't remember what the total was of Procter & Gamble stock, and started actively complaining that Procter & Gamble's return on dividend was not very good, that it needed to shake up its board of directors and get out of its complacency, et cetera, et cetera. After a period of time, he sold his positions. That's what it's normally called. I think he still owns stock in Procter & Gamble, but not at the level that he previously owned. Dividends are paid from after taxes. So they're not pre-tax dollars or post-tax dollars. And of course, keeping stockholders happy can be problematic for organizations. Two classes of stock. I'm going to talk about preferred first because we find more common shares out there and more common stockholders, common share stockholders that we find preferred stock. The preferred people have, as the slide says, a preference when the company pays dividends, and they get paid their dividends that the company declares a dividend before the common stockholders. Notice they can also have some other options here, and let me show you these, make sure they're all on here. The preferred stock could be callable. We talked about callable provision in bonds, which means that it can be paid ahead of time. They can be converted, which means in this case it could be, converted to common stock, and it can be cumulative. Common stock, most basic form. Common stockholders have the right to vote. Usually there's an annual meeting, and the company you own stock in will send you notice, and here's the annual meeting, and here's some other stuff, and then here's people running for the board of directors, and here are the various provisions we want voted on, etc. And then they do get a share in the profits if dividends are paid. Now we need to look at bonds. We've talked about bonds before. We're going to give a little bit more information about bonds. Notice what it says. It is, in this case, now we're talking about corporate bonds. We're not talking about U.S. savings bonds. It is a certificate indicating that an investor has lent the firm money. And it parentheses over here of the government. But right now we're talking specifically about corporations, not the government. The principal is what the bond is worth. And normally speaking, companies issue bonds in the thousands of dollars. And so if you want to say principal, you can say that. You can say face value, you can say that. But that's what the bond is denominated at. That is its worth, if you will. And interest, we all know this. Interest has to be paid on bonds. It's a contractual obligation between the lender and the borrower. It's paid at specified times. The interest rate is usually set for the duration of the bond. and the benefit to this is the fact that the interest payments are tax deductible. Now, these are the different kinds of bonds that we see, and they're around the world, or well, let's just limit that to around the United States, and gives us some idea of their length, etc. I'm not going to read this to you. You can see it graphically displayed in figure 19.2 on page 540. It just gives you a spectrum of them and they're what they are and how they are denominated in some cases, and usually what their maturity dates happen to be. We pretty much know the advantages of issuing bonds, normally known as taking on debt. The bondholders, that's the person who lent the money, is a creditor, but he or she is not an owner, and normally speaking, has no vote or say so in how a company is managed. It could be a stipulation of the bond that the bondholder would have some say so, but that is very, very, very rare. As we said, the interest rate, the interest paid on bonds is tax deductible. They are, of course, a temporary source of funds, and they must be repaid. And if there's a callable feature, the bond can be repaid before maturity date. Now that's a plus, because if it is, then if the borrower finds out that that particular bond now has a lower interest rate and the bond that he or she has can be repaid early, callable, it's to his or her advantage to pay the bond off. Now there's usually a penalty for that, and then renegotiate the borrowing at the lower interest rate. But of course, even when he or she pays this off, they're going to realize some benefit, because they're not going to pay all those extra interest rates. Obviously, borrowing can increase debt, and that may make you look bad in the eyes of other investors. You have to pay the principal when it's due. You have to pay the interest rates when they're due, usually every quarter. And if you don't do either one of those things, then you could be taken to court. And it's just one of those things we really have to pay a lot of attention to. Now, not saying that people don't pay attention to their obligations, but it's something that's critical to pay attention to make sure that something doesn't happen. As I mentioned, one or two of you, or maybe all of you, in some of the responses I gave about chapter 17 and 18 about bonds, Apple, for instance, takes on debt on a routine basis because they have a large amount of money outside the United States. If they bring that back, they're going to have to pay tax at a higher rate than they're paying right now. And so they borrow money, even though their financial picture is very good. These are bond rating agencies. The three known are Moody's, Standard & Poor's, and then Fitch. Those are the three bond rating companies. Pardon me. You can see this slide graphically displayed, figure 19.3 at the top of page 541. We're not going into this other than to say you want bonds that are up at the top. Bonds that are down at the bottom are known as speculative, and yes, they pay high interest rates, but they're prone to default. And so you really have to be careful about those, buying those. You can obviously make a lot of money, but by the same token, you can also lose a lot of money if there's a default. Corporations can issue two kinds of bonds, secured and unsecured. Pretty simple. Secured is backed by no collateral, whereas secured is backed by collateral. And You're not going to get an unsecured loan unless you have a good credit rating. And even then, you may not get an unsecured loan. There's also a thing called a sinking fund. This is like a reserve fund. It's a fallback position, if you will, ensuring that there's going to be enough money left to repay the bondholders. So if you want to look at it this way, it's like a security blanket. We know what a callable bond is. We've talked about that, or has a callable provision, allows the bond to be paid off early. And a convertible bond allows a bondholder to convert the bond to shares of common stock. Now, most of us, if we're going to buy securities, we're going to buy from a person who's a stockbroker. Probably better term is a securities broker, because for the most part, that person is going to handle both types of securities. Notice that this person works for a market intermediary. That is a company that has a seat on the New York Stock Exchange or the NASDAQ, and is empowered to trade securities and is authorized to do so by the Securities and Exchange Commission. And this person works for that particular firm. And he or she is allowed to do the trading for the company. And then there's some online trading services that are mentioned here: TD Ameritrade, E-Trade, and Scottrade, that they do this trading online. These are the 5 investment criteria, and you should ask yourself each of these questions before buying any type of security. What's the risk? We talked about that early. How much will I get back in the long term or the short term? How long do I have to hold the security? A bond, a stock you won't. What's its liquidity? How quickly can I turn this into cash if I have to do so? And then what are the tax implications? I would suggest to you that you do some of the things that are mentioned here. Most of us are relatively unschooled when it comes to buying and selling securities. So it's a good idea to take an investing class. You can do this at community colleges. You can do it at some colleges and universities that have continuing education. And usually the cost of those classes is not expensive, and those classes usually don't last a long period of time. You could go to a conference, although I would not suggest you doing that unless you knew that people were going to be there that spoke in the language that you could understand. And then another option is to go to a library and ask the librarian to point out some books that will give you information about trading securities, pardon me, buying and selling securities. And of course, you can always go online and find information there. What I would tell you about going online is simply this: make sure that you are looking at something that comes from a reputable source. I'm not going to get into that. We don't need to worry about return on investment. And I think if you're concerned about return on investment, and I'm not saying you shouldn't be, you really need to talk to somebody who's a financial planner. You could start out with your local bank or savings and loan or credit union. Many of them will have someone who is knowledgeable about the buying and selling of securities. And if they don't, they will point you to someone who does. This is the big key to any investing strategy that you have. It is diversification. Do not put all your eggs in one basket. And I'm not going to go through this particular scenario here, or this formula, but looking something like that can help you out. And You want to put some money in growth stocks and some in good securities and things of this nature. What is important is to first of all define what it is that you're trying to get from your investments. What's your long-term strategy? And then invest accordingly. Secondly, if you're going to invest, maybe, and more important, if you're going to invest, and especially invest in the stock market, don't invest any more money than you can afford to lose. Now, why do I say that? Well, not because the stock market's going to go down or I think it's going to go down, because I don't. However, sometimes when you buy stocks or mutual funds, the first thing that happens to you is that stock will go down, or the value of the stock will go down. That's a better way to put it. And I will give you an example that some years ago, my wife and I bought a mutual fund, and we still own this mutual fund. And I happened to be in Texas when I was in the Army on a trip, and I just happened to call home, and we were talking. And I said, "By the way, how's this mutual fund doing?" And we just purchased it, and I think right off the bat we lost $400 or $500. Now, $400 or $500 may not be a lot of money, but when you make an initial investment and it's roughly 20% of your investment, that's kind of hard pill to swallow. And 25 or 30 years ago, when we made that investment, that's about what it was. Well, I just said, well, forget it. We've invested money, and we're going to keep it and see what happens. It's one of the better mutual funds we own today. But we were in a position to say, okay, we're not going to be concerned about that. If you're not in that position, don't make the investment. This is a scrutiny that you have to go through with yourself. And, I like the stock market. I believe in the stock market. But I would never tell anybody to go to the stock market without saying to them, there's a risk. And you have to be willing to accept that risk. If you're not willing to accept that risk, then don't get into the stock market. It's as simple as that. Global stocks, something that you can look into. Again, was something that you need to do your homework on. Talk to a financial advisor before you get into that, because as the last bullet says, some stocks are invested in countries that do not have stable governments. And Zaire would be one. Even though the president of Zaire has been in office since, to use an old saying, Hector was a pup, it's not a stable government. He's aging, and there's a lot of cronyism, and they have rampant inflation. So that's not a company that you'd want to buy, or a country that you want to buy their bonds. This is what you can get from investment services and a financial planner, help with retirement planning, savings, investment advice, etc. There's two perceptions in the market. Bull market, which we're kind of in today, says the bulls say the only direction is up, and the bears are just the reverse. This gives you bear markets. This particular slide gives you bear markets over a period of time. Of course, the one up there that we're all familiar with, 2007, 2009, when we were in the depths of the Great Recession, excuse me. See the drop in prices, 52.5%. Select stocks for what your portfolio is asking you to do. What is your long-term game plan for investments? You want blue chip stocks, you want growth stocks, you want income stocks, you want penny stocks. What is it you're looking for? And develop a strategy based around that with your investment. Again, don't put all your eggs in one basket, as we've said before. Stock splits are something that companies do. This helps them give stockholders 2 or more shares for every share that they hold. Obviously, as one of you pointed out, This devalues the stock, or dilutes it is a better word. But notice there's no change in ownership structure and no change in the investment value. I explained that before, but I'll do it quickly. If you own 50 shares of stock and the stock is worth $10, your investment's $500. Pretty simple. Now, if it splits 2 for 1, then you're going to get 100 shares, and the stock price is likely going to be $5. So you still have the same $500. Now, what you hope for is that the stock will eventually come back to $10 a share, and then you'll have $1,000, obviously doubling what you had before. It does happen. Companies do this all the time, and it may or may not be good. While this is a strategy, it's called borrowing or buying on the margin. It's what it says is that you're using some of the stock's purchase cost from the borrowing from the brokerage firm. Notice here, and I want to explain this again to you, and I'm going to read a little of this, is the portion of the stock's purchase price that the investor must pay with his or her own money. Usually, it's not the full face value. One of the things that I want to tell you is, and this is what the next bullet says, you have to be very careful about this, because if the broker calls the margin, you have to pay up today, not tomorrow, and you can't negotiate that. He or she calls the margin, you have to pay up. This is what happened in 1929 with the Great Depression. Many people had bought stock on the margin, and the margin got called, or the margins got called, and people couldn't pay. And that caused a lot of problems. This is a piece of advice I would give you. Don't buy on the margin unless you're a very sophisticated stock purchaser. Even then, I wouldn't suggest that you do that. This particular slide gives you an idea of how to read the stock quotation. This is Microsoft. You can see this at figure 19.4 at the bottom of page 547. I'm not going to go through this because it's very easy to read and very easy to go through, so we don't want to spend a lot of time on it. Most newspapers no longer print exactly this way. You can go to the internet and get it. Newsprint is costly, and they stopped doing that. Wall Street Journal did it for a long period of time. New York Times used to do it. You don't get near the information that you used to get. Even USA Today does not do that. So you won't find this most places. You can go to your stockbroker and get it. You can go to the company's website normally and get it, but you won't get it from a newspaper like you used to. These are the top 10 or top 5 research sites for financial news, and this is where you can get the information that we were just talking about. Now, these are for bond investors, and this is what bond investors are going to ask. Do you have to hold the bond with a maturity date? Well, the answer to that is no, you don't, but you're foolish if you do not. Same thing with government bonds. If you have a government bond, today they're 30 years in duration. You're going to get your money back, but you're going to lose some amount of interest. Same thing true if you're going to hold a bond. If you sell the bond before a maturity date. How can you assess the investment risk of a particular bond issue? You need to go to the bond rating agencies, and they're going to let you know what that particular is. Remember junk bonds. We talked about this before. Possible high rate of return, but also very high default rates. So you really need to be careful about that. Again, that's, don't buy those unless you have money that you can afford to lose. If you can't afford to lose it, don't get into it. This is a bond rating that you can see. Goldman Sachs Group, figure 19.5 at the top of page 549. Again, I'm not going to go through this because it's very easy to read and to understand. very popular ways to invest: mutual funds and exchange traded funds, ETFs. The mutual fund is, you can buy these through an organization that sells this type of securities. And the organization buys stocks and bonds and then sells shares of those securities to individual investors. Then they pool that investment and buy more stocks and bonds according to the fund's purpose. And there's a protection in this because there's large numbers of people in the fund. So your chances of losing a lot of money are somewhat diminished. I say somewhat because there's always that potential. Exchange traded funds are similar to mutual funds, except they're traded more like individual stocks, and they can be traded throughout the day, which is not the same as for mutual funds. This is something that people have complained about learning from about mutual funds. Reform the rating systems, give information for free, reduce the fees, be transparent, etc. This is just showing you how many households invested in mutual funds going back to 1980 and now through 2010. This particular slide, which you can see figure 19.7 on page 551, gives a comparison for you of the type of investments, the degree of risk, expected income, and possible growth capital gains. It's not something that I want to read to you. It's not something that is going to take me to read to you for you to understand. It's very simple. It's a good guide. If you don't keep your textbook, do yourself a favor and make a copy of this page so you have it, because it will help you if you're deciding that you want to invest in securities. This is just a slide that shows the original number of companies in the Dow Jones Industrial Average. And that was, I don't remember, somewhere around 1900. It might have been a little earlier, it might have been a little later. It's something that we can see here and something we can use to help us along. It gives you some of the ones that are in today. Now, the Dow Jones Industrial Average is the most often quoted, and it's the most often quoted because it's the easiest to calculate. However, notice here on this slide, it is the average of 30 selected stocks. It does not give a broad base of the stock market like the Standard & Poor's 500 does, and so it's probably less valuable in understanding what the worth of the stock market is on a particular day. However, it is easy to calculate, and it is the most quoted stock average. Yes, there's market turmoil. We know that. We've seen that for a period of time. We are going to, we're not going to spend a lot of time, I did something I shouldn't have done here. We're not going to spend a lot of time on what we've done in the past. I'll get these back up here so we can see them. Okay, and I'm not going to mention those particular days because we don't have to speak of that. And we've had lots of turmoil, and we can expect it again. I don't think we're going to see it as we've had it in the past. Yes, there's program trading, as I mentioned, that people like organizations like CalPERS can really affect the market. And this is one of the problems we have, and there's some issue with that, and the exchanges are trying to work to ensure those types of things don't happen again. Who is at fault in the financial meltdown that we had, I think the best thing to say is probably some people who had greed somewhere in their name, and they were chasing things that people, they put together complex trading uh, uh, instruments. That's the word I want to use, that people didn't understand, and probably even the people that put them together didn't understand them. And instead of somebody asking a question, why is this going to be a benefit to anybody? They didn't want to look stupid, so they didn't ask any questions. And these instruments were foisted on people, and after a while, the market could no longer support them. And so that's what we had, and we found out that we wound up reaping what somebody sowed. And finally, we just have to make sure that we pay attention. This is the Dodd-Frank Act. I'm not going to go through that. It can be complex to read, but we have a real issue in this country, and we really need to come to grips with it. We have one political party that believes that the government should do a lot of regulation. We have another political party that said there shouldn't be any regulation because the markets will take care of themselves. They'll regulate themselves. Well, the fact of the matter is, unfortunately, the markets don't regulate themselves. They should. They're set up to do that, but they don't. And the market itself is made up of individual people, and everybody in the market is not the most ethical person, unfortunately. So we need to find some common ground, some middle ground, where we can have the right amount of regulation and still let the market have free and unfettered access to do what it wants to do within those restrictions. Unfortunately, we talk at each other, not to each other. And so we need to think about that. We need to reform the system and make sure that everybody is in there on has an equal access, and we have somewhat of an equal playing ground. Obviously, people who have a lot of money are going to be able to influence the market much more than people like us. But we don't want them to have greater access than we do. That brings me to the end of chapter 19. It's 5:17. It's almost 5:18. So we'll take a break to 5:21, and then we'll come back and discuss money, financial institutions, and the Federal Reserve. Thank you. Please come back at 5:21. All right, 521. Pardon me. We're back with Chapter 20, Money, Financial Institutions, and the Federal Reserve. Let's look at our learning objectives. Explain what money is and what makes money useful. Describe how the Federal Reserve controls the money supply. Trace the history of banking and the Federal Reserve System. Classify the various institutions in the U.S. banking system. Briefly trace the causes of the banking crisis and explain how the government protects your money during such crises. Describe how technology helps make banking efficient. And finally, evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. Well, the question is, what's money? And everybody knows what money is. We have it in our pockets or our wallets or our purses or whatever we want to say. So it's not something that we don't know about. But it is what we being people, what we normally accept as payment for goods and services. Now, years and years and years ago, 1600s, the currency, money in Holland, now known as the Netherlands, was tulip bulbs. Now, can you imagine how many tulip bulbs you would have to carry around to satisfy a debt of $500 or to buy something worth $500? And that's why we have money, because it's easy for us to carry around. We'll get to some of their real advantages in just a second. Barter, on the other hand, as the term suggests, is the direct trade of goods for other goods and services that may not be of equal value. And my best example for this is when I used to teach this class in a face-to-face setting some years ago. I would ask the class, please give me an example of a barter. And one of the women in my class said, well, I'll give you an example. And she said, I needed some furniture moved, and I knew a gentleman that owned a truck, and he could move the furniture for me. And I said to him, if you'll move this furniture for me from place to place, I've forgotten what it was. If you move this furniture for me, I'll fix you a chicken dinner. And so he said, yeah, that's a deal. And so they made it. Now, how much furniture was going to be moved, I don't know. She didn't say, and I didn't ask because it wasn't germane. How much the chicken dinner cost when she fixed it, I don't know. Again, same things apply. But they made a trade, a barter, if you will. And so, and no money exchanged hands, and both people were satisfied. She got her furniture moved, and he had a chicken dinner. So these are the things that money satisfies for us. So why would you use money and not something else to pay our bills and to buy goods and services? First of all, money must be portable. That's what we talked about before. How many tulip bulbs would you have to walk around with to satisfy a debt? It needs to be easily divisible. Tulip bulbs aren't easily divisible. And what this means is everybody knows that a dollar is worth 100 pennies or 4 quarters or 10 dimes or 20 nickels. It has to be stable. Now, stability there talks about backing by a government. Very few, if any, currencies today are backed by a precious metal like gold, like the U.S. was for a long period of time. We still have gold reserves. Don't misunderstand me. But it's different today. It has to be durable. And we'll have a slide here in a few minutes that says, which we won't spend a lot of time on, how long a paper piece of currency in various denominations lasts. And of course, we know that coins last for a very, very long and then it has to be unique. And the uniqueness is what we see in the picture here, a picture of Ben Franklin, and there's some various other distinguishing characteristics in this particular bill, a $100 bill, that says it's an American note that's worth $100. I am not going to go into Bitcoins simply for the very fact of the reason I don't understand digital currency very well. I know that it is attractive to a number of people. I do suspect somewhere in the future we may see money as we know it today be out of vogue, if not out of circulation, or both. But there is some real chance for chicanery here with digital money. And I think until those bugs are worked out, we're not going to see wide acceptance of digital money, whether it's called Bitcoin or something else. Now, when I say these things, does that mean that I want to keep the status quo? No, I don't think so. If I wanted to keep the status quo, we wouldn't have computers, and we still have typewriters and landline telephones and a few other type things. However, I think because the Bitcoin was kind of thrust on people, if you will, it's just a term I'm using, without a lot of thought going into it, that it's became problematic. Now, there are those who would disagree with me and say it's only because of governments setting regulations that we don't have wide acceptance of digital currency. And my counter to that would be that's probably true to some extent. But the other part is that there have to be some rules and regulations about how these things, in this case, Bitcoin, digital money, is traded, and how people can accumulate wealth based upon the trading or accumulating of digital currency. That has not been determined. And until that is determined, we're going to have some issues between those folks like me who are older, who not necessarily don't see the value in it, but think we need to have some parameters, and other people who think the sky is the limit. Again, it goes back to whether we need to have regulation or we don't need to have regulation. This is one of these things where I don't think the market can correct itself. And I think we need to have something in place to do that. Now, when I say that, we all know that Bitcoins are a reality. And how much trading is going on with Bitcoin right now, I don't know. It's had a lot of publicity, for lack of a better term, about a year ago, maybe a little bit longer ago than that. It's kind of dropped out of sight lately, at least out of my sight. I've not seen any articles in the New York Times lately or other places about Bitcoin or something like that. Now we're starting into the Federal Reserve, and we're going to talk about the money supply. And the money supply is made up of three categories: M1, M2, and M3. Now that's just terms that are used. Don't be concerned about that denomination, that M business. Notice that M1 money is money you can get almost immediately. And it's the things that we know about: paper money, traveler's checks, and things of that nature. M2 is M1 money plus money that takes a little bit of time to get. And these are things like savings accounts. Now, for instance, if you go to the bank, wherever you bank, and let's say you have $5,000 in your banking account, in your savings account, and you say to the banker or the teller, I want to clear out my money. He or she may say, come back tomorrow and we'll have the money for you. Or come back in an hour, we'll have the money for you. Or a couple of hours from now, we'll have the money for you. That money is not immediately accessible like a checking account is. Much different. And then, of course, other things that go on are mutual funds. And then M3, let me get this up so you can see this a little bit better here. M3 is M2 money plus money from institutional money like market funds. So 3 categories of money. Most of us will have money in the M1 and M2 categories. Didn't mean to do it, excuse me. That slide, we're not going to go along. This just gives you an idea of how long paper money lasts. You can see that here graphically displayed. Dollar bill lasts 21 months. Then there's some other ones in various categories. And we would think that maybe a dollar bill would last less than the $5 bill. This says it doesn't, but that's not something we really have to be concerned about. This is just things that we need to know. And it's kind of one of those gee whiz slides like I like to talk about. Here are some things that may be of interest to you. $1 minimum wage came in 1956. We're past that today, but many think that we need to be, pardon me, well beyond where the minimum wage is today. And there's some other type things here that you may be interested in looking at. But again, most of it is falls into gee whiz, the same as this next slide does, and we're not going to spend any time on that at all. Now, these are some things we have to be concerned about, and businesses are concerned about it because it affects their bottom line, and that is the exchange rate of money, what money is being exchanged for. If we have a falling dollar value, which we do not have at the present moment, the amount of goods and services that we can buy will decrease. Now, normally speaking, when the dollar falls in value against other currencies, it really doesn't affect what we purchase domestically, but it does affect what we purchase goods that are imported, like French wine, German cheese, Italian bread, French bread, things of that nature. A rising dollar says we can buy more goods and services, again, from overseas. So what makes the dollar rise, the dollar fall? It really has a lot to do with speculators and, again, with confidence. Now, for instance, I don't know if you pay attention to the relative value of other currencies against the dollar, but the British pound has been falling against the dollar for some period of time. Now, the last I looked, it was trading at around $1.30. What's meant if you wanted to buy a pound, you had to give a person $1.30. That's the official exchange rate. If you went someplace else, it was probably going to be a little bit higher than that. But you had to give $1.30 to get a pound. Now, I'll contrast that for you. The last time my wife and I were in England, it's been some years ago, the pound was trading around $1.60. Might have been a little bit less than that, might have been a little bit lower than that, or a little bit higher than that. But that's a significant drop. Now, it's 10 years difference, I realize, but it's still a significant drop. And a lot of that has been caused by the decision in the United Kingdom to get out of the European Union. And so that's affected that. And there's a confidence level that goes into that. How confident I am in the stability of this country's currency. And that has a lot to do with it. And of course, there's speculators that also do that. Now, this is the impact of the falling dollar. If the dollar is less in strength against, I'm going to use the euro now. It's trading pretty well against the euro right now. Again, for comparison purposes, the last time my wife and I were in Europe a couple of years ago, the euro was $1.36, $1.37, $1.38, somewhere in that area. It means if I had to give $1.38 to buy a euro. It's down around $1.11, $1.12 today. So that's a significant drop. So what happens is when the dollar is weakened, people want to buy more American goods because they're less expensive. And of course that helps our businesses who are exporting. right now, it's causing some of our businesses some loss in profit. Not that they're not still profitable, but loss in profit because the dollar is stronger against other major currencies. And of course, when it falls, then that means tourism is going to increase in this country, which is good for our hotels and parks and things of that nature. Now, we're going to talk now about the Federal Reserve. These are, notice that it's different things there. It has the Board of Governors, Open Market Committee. There are 12 Federal Reserve banks. We'll show you a map of those banks in a second, where the banks are located. There are 3 advisory councils, and then there are member banks of the system. Every federally chartered bank has to be a member of the Federal Reserve and has to borrow its money from the Federal Reserve. This is the map, which you can see in your text on page 571 at the top, figure 20.1, giving you the areas where the branches of the Federal Reserve Bank are located, or as the text says, more appropriately, the Federal Reserve District banks. Sometimes I have seen that mentioned as regions. Either way is fine. These are the tools that the Federal Reserve uses to control the money supply in the United States. And see this in your textbook, figure 20.2, again on page 571. And that leads us to today's lecture discussion question. What are the 3 tools the Federal Reserve uses to control the money supply? What is the Fed trying to accomplish with each of these methods or each of these tools? What are they trying to accomplish in controlling the money supply? So again, the lecture discussion question for this week is, what are the 3 tools the Federal Reserve uses to control the money supply? And what is the Fed trying to accomplish with each one of these methods or tools that it uses in controlling the money supply? The Federal Reserve was established actually in 1913, but it stemmed from a cash problem that we had in 1907 and actually a market crash that led to the creation of the Federal Reserve System. Notice here, so that all federally chartered banks had to join the Federal Reserve. Now, I want to make this distinction because for a long period of time, it may still be true in some states. There are state chartered banks, and state chartered banks do not have to join the Federal Reserve System. I'll give you a case in point. When I was in the Army, I was sent to a school in Fort Bliss, Texas. That's in El Paso. And I was going to be at the school for 7 months. And the folks that ran the school suggested that everyone in the class open an account with a local bank. So I did that. There was a branch bank. I couldn't even tell you what the branch bank was anymore. Don't remember. And I had a couple $100 I put in there in case I needed to take some money out. Normally, I didn't have that problem. My wife would send me a check if I needed to pay for something. I didn't have money to pay for it. And but I opened that account just because it was a safety net. Well, it was a state chartered bank, and if I wanted to do any transactions with that bank, I had to go back to that branch. That's not true with a federally chartered bank and its branches. You can bank at any one of the branches. But with a state chartered bank, I had to go back to the branch. I skipped a section on check clearing. That really is not something we have to pay a lot of attention to. And so I didn't really get into it, and it's not something that you have to be concerned about. This particular slide is a gee whiz slide, but it is gives us some important information of the largest bank failures in the United States and when they occurred. Not something that you have to commit to memory, but it is something that you do need to be aware of and get something around. These are the different types of institutions in the overall U.S. banking system. Commercial banks that we kind of talked about just a minute ago, and we're going to get into greater discussion here in a minute. Savings and loan associations, credit unions, and then non-banks. Commercial bank is in the business to make money, and it uses your money to make money. It uses your money and lends it out to other folks and charges them interest, and it pays you back interest for the use of your money. Now, it doesn't pay as much interest as it used to, but you still do get some money back. These banks get deposits from people like us and from corporations, and then they lend those funds out. Two types of customers, and the customers can be one and the same. Those that put money into the bank and those that borrow money from the bank. So you can be one and the same. Now, for instance, if you have a mortgage, many people will have a mortgage on their house, and they'll also have an account with the bank that lent them the mortgage or the other institution that lent them the money for the mortgage. Same is true with my wife and myself. We have a mortgage with a local bank, and we also have an account with that bank. Now, here's what kind of services they offer. Demand deposit, that's normally known as a checking account. And as we talked about earlier, you go in and say, I want my money out of the checking account. They're going to give it to you. A time deposit, however, is a savings account, or certificate of deposit, and you may have to tell the bank ahead of time you want to get the money out. And they'll tell you, as we talked about before. Now, time deposit is what's known as a certificate of deposit, and it's time because it says, I'll put my money in for a certain amount of time in the bank, and you, Mr. or Miss Banker, will pay me a certain amount of interest if I keep the money in the bank the whole amount of time that we contracted for. Now, so that interest, the full amount of the interest, will come at the certificate's maturity date. Now, can you take that out early? Yes, you can, but you will forfeit the additional interest, and sometimes there's also a penalty for early withdrawal, which is over and above the forfeiture of the additional interest. Savings and loan associations are similar to banks, but they're different. They do accept savings and checking, and they provide home mortgages. As a matter of fact, that's what savings and loan associations were set up for, to promote home mortgages. In other words, lending money for people to buy homes, and also having savings accounts. Now, there was a savings and loan in my home state, Kentucky. It was right across the river here from Cincinnati, where my wife and I had an account with them for a number of years. We had our first mortgage with them. My uncle was president, well, was treasurer first, and then president of the savings and loan for many years. But they did not have a checking account. And when I first started doing business with them, they do today. I no longer bank with or have a savings account with them for a number of reasons. I'm not mad at them, I just don't. My wife and I moved out of the area for a while. We paid off our mortgage, and because we were out of the area, we didn't keep any additional money there. Notice that these institutions were often called thrift institutions. They still are in some cases, because the original purpose was to promote home ownership. And you couldn't, years ago, the thought was you couldn't own a home unless you were thrifty. So thrift institutions. Credit unions are similar to banks and savings and loans associations. The difference is they're not-for-profit organizations, and they are owned by the people that deposit money with them. They're a cooperative. Remember, we talked about cooperatives way back early in the course. They also offer a full plate of banking services to the members. Notice also, because they're nonprofit organizations, they're exempt from federal income tax. Now, the normal restriction is you either have to work for the institution that has the federal credit union, or you have to somehow be related to somebody who does to be able to join that credit union. Some have relaxed their membership priorities, and others have not. Non-banks are exactly what they say. They're not banks. They're life insurance companies. They're pension funds. They're brokerage funds. They're other ones that offer financial services. They do accept deposits and provide many of the services that regular banks do as well. Online banking is growing, and that's one of the reasons that I did not talk about the check cashing procedures that the Federal Reserve goes through, because as more online banking has come into being, the need for check cashing, check processing facilities by the Federal Reserve have diminished. Several have closed in recent years. Helps protect identity theft, helps with personal management of funds. You can get messages back quickly, etc. So it's something a lot of people do, and I think that we'll find more and more of that online banking as we go along. The banking crisis caused a lot of problems. We could talk about this for many hours. And we bailed some banks out. Some banks maybe shouldn't have been bailed out. We have this term about too big to fail. And I think that's something we need to grapple with. Do banks need to be in all of the areas that they're in today? We had a bill, we had a law called the Glass-Steagall Law, which prohibited banks from doing some of the things they're doing today. That barrier was broken in the late 1990s because people thought it was a good thing to do. I think we need to perhaps relook at that and determine if the bank should be some of the big banks like Chase Manhattan and other banks like Wells Fargo, who's been in the news lately, U.S. Bank, and some of the other huge banks, if they really need to be that size. We need to make sure that we're doing this. Notice, I think that most of the problems with the financial meltdown were caused, the big banks had all the problems, the banks that are associated with Wall Street, etc. The Main Street banks in the small towns usually didn't have that kind of problem. Very few of them, if any of them, had to be bailed out. So we need to think about this and find out what's best for the consumer, not what's best for the people on Wall Street, not what's best for the big banks, but what's best for people like us. And I think if we can figure that out, keep all the lobbyists out of the equation, we might be able to get to something that we can recognize again. We do have insurance on funds in the banks. We have Federal Deposit Insurance Corporation, which guarantees bank deposits up to $250,000. Notice it's an independent agency. Savings and Loan Insurance Fund, which is similar to FDIC, and then a National Credit Union administration, again, up to $250,000. We talked about technology changing banking, which is what this next slide talks about. And I don't think we need to spend a lot of time on that. We do know we have electronic funds transfer system. We also have debit cards that can be done, and it's a very, very good thing to do, but we don't really have to talk about this. It does affect the banking system. And one of the things we need to do, we need to remember, we're using debit cards. That's instantaneous. As soon as you put that debit card in and it's accepted, that money comes out of your account. And so that's something that we investors need to remember, because if we don't, it's going to cause us some problem. We have to remember it's much different than a credit card. In a credit card, we are actually getting a loan, and we have to pay that loan off when the loan is due. Normally it used to be a month. I think it's down to like 24, 25 days today. But it's different than a debit card. And we have to make sure we understand that, so we're not making unwise financial transactions. Letter of credit is promised by a bank to pay a given amount if certain conditions are met. A banker's acceptance is a promise the bank will pay somebody a specified amount at a particular time. Money exchanges allow companies to go through exchange rates and currencies to use a particular currency of a country where it's doing business. Pluses and minuses to that, obviously. Here are some issues that we have to come to grips with, not we as individuals, but certainly as countries. World Bank and the International Monetary Fund. World Bank helps less developed countries improve their productivity and standard of living. There's some people that would challenge whether the World Bank actually does that. That uses more of a stick and carrot approach, and the stick is used more often than the carrot. International Monetary Fund fosters, as the slide says, cooperation among countries to help stabilize exchange rates. About 188 countries participate in or are part of the International Monetary Fund. And finally, International Monetary Fund and the World Bank are trying to think about global issues that are very serious. Obviously, pollution is one, and things of that nature. And trying to get ahead of the power curve to preclude any potential economic crisis. Sometimes I think that's pie in the sky, because it seems to me that if we get into good times and we let our guard down about what might lead us to a financial crisis, and we don't read the tea leaves that are plainly in front of us, and we start doing things that we promised we wouldn't do before. I say we, not me or not you, but people in the banking system, and then we're back into the same jackpot or jackpots that we were before. Well, that brings me to the end of chapter 20. Again, the lecture discussion question for this week: what are the 3 tools the Federal Reserve uses to control the money supply, and what is the Fed trying to accomplish with each of these methods or tools? And we will be back next week to discuss the 3 bonus chapters, chapters A, C, and D, and spend about the same amount of time next week. I thank you for your attention, and good night.